Edwards Limited is the first good question, and which is really something that you have to do backwards, frontwards, sidewards, all kinds of words to make sure that you 100% understand how you should disclose all the items in a set of financial statements. Now, there is a number of things that you haven't come across as yet, which we will only do when we do companies, but that is not the essence of this question. The essence of this question is the income statement. And except for the dividend story that is included in one line item in the income statement, and maybe the tax calculation, which you're not going to be able to do now, but that is also not the important thing. The important thing of this question is that you can distinguish where certain items should be shown in the income statement and what the disclosure of those items are looking like. So they say that Edwards was incorporated with the following authorized share capital, and don't worry too much about that at this point of time. When we do companies, you will understand more what that is all about. They give you the trial balance as at 30 June 2015. They tell you that ordinary share capital was 480,000, 10% redeemable preference shares was 62,500, share premium, retained earnings, property, plant and equipment at book value, investments at cost, stock on hand 30 June 2014. So the trial balance is 2015. Clearly, it is my opening stock. Stationery on hand 30 June 2014. Also opening inventory in stationery. Other current assets, bank loan at 12%. Provisional tax paid. Now, guys, I need to explain to you very shortly what provisional tax is all about. A company is going to pay tax eventually on the profits that he made for his financial year. The receiver of revenue says, I cannot wait for you to complete your figures for the full year before you're going to pay tax. He says, I don't have the luxury for waiting for that money. Therefore, 6 months after the new financial year has started, you have to make a provisional tax payment to me. How does it work? Now, let's say the financial year starts at the 1st of January. Come 30 June, the company must estimate how much profit they think they're going to make for the full year ending 31 December 2012. Now, let's assume that they assume they're going to make a certain amount of profit, and based on that, they're going to pay 28% tax. Now, that amount of tax that they have calculated that they're going to pay, let's assume it's 100,000 Rand, that they say it's going to be the tax they have to pay on their profits for the year, estimated. They are going to divide that by 2 now, because only 6 months has gone past in the current financial year. Now, 50% of the 100,000 which they have calculated the total tax liability of the year to be, that is going to be paid now at 30 June of that same year. So what is my accounting entry? I'm going to credit my bank with the 50,000 I'm going to pay. And then I'm going to debit the receiver of revenues account, 50,000 Rand. Now, from the date of payment, let's assume we've paid the 1st of July. From the 1st of July up to the end of the financial year, the receiver of revenue will have a debit balance of 50,000 Rand in his account. And that debit balance is going to be shown as a current asset on my statement of financial position. Now, let's assume the whole year gone past, at the end of the year comes, and we redo our tax calculation now based on our actual profits for the year. And when we work out our total tax liability and our total profits for the year, our actual tax that we have to pay for the year is 110,000 Rand. Then we're going to make provision for the commitment in our books. How? We're going to debit the income tax expense account, which you're going to show in your income statement as your taxation charge for the year. And you're going to credit the receiver of revenues account with what? With a total tax liability of the year of 110,000 Rand. So in my income statement, I'm going to show a tax expense of 110,000. And what is the balance on the receiver of revenues account going to be after I've passed this entry? There will be a credit on the SARS account of 110,000, but that 50,000 which I've paid on the 1st of July, that was a debit on that account. So what is the net amount that I owe the receiver of revenue at the end of the year? 60,000. 110,000 total commitment for the year, less the amount that I've already paid on the 1st of July, 50,000. So I still have to pay him at the end of the financial year, 60,000. So provisional tax paid will never, ever be in your income statement. That is a statement of financial position entry. Other current liabilities, interim dividend. Now, you know that a dividend is a profit distribution made to the owners or to the equity holders of a company. Now, an interim dividend is a dividend that the company pays somewhere during the current financial year. Now, you have to distinguish between an interim dividend and a final dividend. The interim dividend is being paid during the course of the year. A final dividend is the final dividend payable at the end of the financial year. Now, equity distributions are not shown in the income statement. So dividends paid by an organization, that goes to the statement of changes in equity because it is a distribution of the profits to the equity holders of the entity. So never ever will a dividend paid be included in the income statement. However, if an entity has a share investment in another company, and here we have investments at cost, then most probably this company, Edwards Limited, could have received a dividend from that investment of that share, from that shares that he holds as an investment in another company. Now, if you receive a dividend, now yeah, we have received dividends. Dividends received. Now, dividends received is an income figure, and we're going to account for dividends received in our income statement under investment income. So, dividends received is accounted for in the income statement, but dividends paid is accounted for in the statement of changes in equity. Very, very important. Good. Then we get sales and purchases, and when you get purchases, you know it's a periodic system, and then you also have stock on hand at the beginning of the year. So clearly a periodic inventory system. Sales returns. Now you know that we're going to subtract the sales returns. Let's do that immediately from our sales. And then we have dealt with that, then we don't have to do that later or going to forget about that later. What is freight on sales? Do we have to subtract that from sales? Never in your life. Freight on sales is a normal selling expense. So that is going to be a part of our selling and distribution expenses for the year. Proceeds on the sale of equipment. If you don't know by now that is something seriously wrong, and I have to rectify that in my books, then you will probably never know that. Interest earned. So probably interest earned and dividends received both investment income. So there's a separate line item in my income statement, investment income. Rent earned, that is a separately disclosable item on my profit before tax note. Freight on purchases, that should be part of my purchases related cost. Advertising is distribution cost. Discount received. Guys, do we have an account like that? No. So let's take it out. Where should it have been accounted for? It should have been accounted for against my purchases. So we do not have a discount received. Loss to factory due to windstorm damage, salaries and wages, other admin expenses, other operating costs, and other distribution costs. Now, what this question requires from you to do the statement of profit and loss and other, comprehensive income for the year ended 30 June 2015 in accordance with IAS 1. Include the note from operations, and comparative figures are not required. Okay, so we have to do the note from operations. That is your profit before tax note. Let me just shout at that. Now, where do we start in a question like this? You're going to start by writing down the skeleton, the framework of the statement of profit or loss and other comprehensive income. And you're going to start with the top, with your note. You're going to write the heading of your note. You're going to write in the meantime income and expenses. Income figures, you know that there won't be many, so you're going to most probably leave open 3 or 4 lines. And then you're going to have expenses. And as you're going to go along in the question, you're going to complete the question. Please do not put any unnecessary items on the face of the income statement. If you're going to do so, you will be severely penalized in the marks that you're going to receive. Okay, now let's start. The ordinary share capital was issued at R2.40 per share. At the annual general meeting, the shareholders approved a final dividend of 25 cents per share. The bookkeeper included this in other operating costs. Now, I've just told you that if I pay dividends, dividends paid is not an income statement item. It is a statement of changes in equity item. Now, a dividend is always based on a cents per share. That is why they gave you the issue price of the shares. Now, if I look at my ordinary shares, the total amount that we've raised was 480,000 Rand. If we did issue the shares at R2.40 a share, it means that we have issued 200,000 shares at R2.40 to get 480,000. Now that dividend that we have declared is 25 cents a share. So therefore, it's the 200,000 shares multiplied by 25 cents a share, and that gives us then 50,000 Rand. Now, once we've done companies, you will know that I am not allowed to declare an ordinary dividend if I didn't declare the preference dividend first. So therefore, if a final dividend was declared for ordinary shares, it means that by implication, I have also declared the preference dividend. Now that 10% there is the indication of the dividend rate attached to the preference shares. So the dividend I'm going to declare is going to be 10% of 62,500, which is the capital amount, 62,500, and that equals 6,250. So the total dividend there, 5 cents, was 50,000. So the total dividend of 56,250 Rand was included where? Was included in other operating costs. So therefore, I have to take it out of other operating costs. So let's start our calculations. And we're going to do other operating costs separately, other distribution costs and other administrative expenses. And let's start with these figures here. So other administrative expenses, I'm going to put on the face because there's not a lot of them. So other administration expenses, we're going to start with the 16,000. Admin expenses, we're going to start with the admin expenses that they gave us there, which was 30,000 and operating cost of 86,000. So 30,000 and operating expenses, 86,000. Now they say that they've included this dividend in other operating expenses. So therefore we want to remove that out of our operating expenses. So less 56,250, I'm going to take it out of the expenses and I'm going to do that as a distribution in my statement of changes in equity. Don't worry about how we're going to do that. We're still going to get there. All you have to know for now is to take it out of my expense figure. Good. The bank loan was taken out on 1 November 2014 for the purchase of new equipment. Now, if I look at my trial balance, there's no financing cost or interest paid somewhere in my trial balance. So obviously we have to make provision for that now. The loan was for 110,000 Rand. So 110,000 multiplied by 12%, multiplied, we've only taken it from the 1st of November, so that is 8 months. So we're going to show financing cost in our income statement, 8,800, 110,000 times 12% times 8 months. Now, I haven't spoken about this. Let's quickly talk about this. You're going to write the skeleton before we go in, and then we're going to complete it as we go along. The name of the entity on a separate line. If you don't put it on a separate line, you're going to lose all the layout marks that you can get for free. Statement of profit or loss and other comprehensive income for the year ended 30 June 2015. They did not require comparative figures. So you have to have a column for note. Now, in this question, they only require the profit from operations, which is the profit before tax figure note. So it's that there will be your note indication, 2015 Rand. Now, you see that I've drawn a very big line on this side here, and I've done the calculations on that side of the line. The reason for that is I'm not allowed to show any calculations on the face of my statement. And now you can see that the statement is on this side and the calculations does not form part of the statement, but clearly I can do all my calculations there that I can, and I can see exactly how did we derive at the figures. So the finance, once we've written down the whole skeleton, we know that we have a line item for financing cost, and as we're completing this whole thing, step by step, we can complete the figures as we go along. So there's the 8,800 Rand then for financing costs. Also write down your profit before tax note. You can start then with Edwards Limited, notes to the financial statements for the year ended 30 June 2015. Profit before tax, profit from operations is derived at after taking into account the following. 2015 Rand, and here we have to distinguish, that's not revenue, that's income. Between income and expenses, revenues in the income statement, that replaces sales. So income and expenses. And under income, well, there's nothing to do now, just leave open a few lines, and the expenses we're going to complete as we go along. Great. Stock sheets revealed the following amounts at year end. Stationery on hand at year end 600 Rand and inventory at year end 16,000. Now, nowhere in our trial balance, under the income statement section, we had stationery expenses. But we had stationery on hand in the beginning of the year of 7,400, and we have stationery on hand at the end of the year of 600. So the difference between the two must be our stationery used in the current financial period. Now, the people who is usually the consumers of stationery is the admin department. So part of my admin costs, we're going to have stationery used 6,800. So you park it. In my calculation, because it's a fairly long calculation, I cannot do everything on this side of the calculation, so therefore Calc 4, and here is Calc 4. We're going to do this here, but I can see clearly, say for instance you run out of time and you cannot get to the final figure, I can see that that was your intention. You worked towards a final figure and you knew exactly where to park that final figure in the income statement. Therefore, you will not lose any marks if you do it like that. Great stuff. For the closing inventory, we will have to use when we do cost of sales. So, included in other operating expenses is the depreciation for the year, machinery and equipment 14,000 and vehicle 9,800. On 30 September, equipment was sold and the proceeds were credited to the proceeds on sale of equipment. Huge sin. No entry was made. The equipment had been purchased on 1 July 2013 at a cost of 24,000 Rand. Machinery and equipment is depreciated at 25% per annum on the reducing balance method. So we will have to work out what the current year's depreciation was because they didn't pass clearly any depreciation on this equipment that I've sold. Also then, the vehicle, they've told us that the vehicle is used by the managing director. Now, if the vehicle is used by the managing director, it means it will be other operating cost and not selling and distribution because the managing director is looking at the whole company as a whole. So let's go and calculate what the profit or loss was on the sales transaction, and we have to rectify our depreciation charge in order to include the depreciation on this specific item that we've sold. The cost was initially 24,000, diminishing balance method. So in 2013, we would have written off 25% of the 24,000. In the current year, the carry value of the asset at the beginning of the year was 18,000, multiplied by 25%, multiplied by the 3 months that we've used the asset, which gives us 1125. So the accumulated depreciation as at the date of sale was 7125. The carry value of the asset as at the date of sale, 16,875 Rand. The proceeds is 22,000 Rand. I just forgot to tell you that you have to ignore that in this question. So there was a profit on the sale of this asset of 5125. Now the profit on the sale of the asset of 5125, that is other operating income. So we can park it on our income statement under other operating income. There it is. Other operating income, 5125. The additional depreciation, which we had to provide on the vehicle that we sold, 1125, is an operating expense. The 14,000 is already included in the operating expenses, but the 1125 still needs to be included, so therefore I have to add it to my operating expenses. Debtors amounting to 3,500 Rand still have to be written off, so I'm going to debit credit losses 3,500. That is a separately disclosable item, so obviously in my note I'm going to have credit losses 3,500. Guys, the sequence of the items here under income and the sequence of the items under expenses does not matter as long as you're going to disclose everything that you should disclose. So there's our credit losses written off. We're going to have an expense item for 3,500 Rand. Now, as what are we going to classify that? It is not a selling cost. Why not? Because who is responsible for making sure that a client is creditworthy and that we can sell on credit to a certain entity or person? The admin department. So if we're going to write off credit losses, it is definitely not the fault or mistake of the sales personnel. It is something that happened in the admin department that went wrong. So 3,500 Rand worth of credit losses is going to be classified as an administration expense, credit losses 3,500 Rand. Included in sales is an amount of 1,000 Rand from a debtor which was previously been written off. So clearly we have to take it out of our sales figure there, minus 1,000 Rand, and we're going to have credit losses recovered. Now we have to disclose credit losses written off, and we have to disclose credit losses recovered in our profit before tax note. So in our note, under income, because it's an income, credit losses recovered, 1,000 Rand. Oh, I forgot about this one. Profit on the disposal of assets, that needs to be shown as well. So profit on the disposal, the 5125 that we've worked out there, that must be shown as part of our income as well. Right, credit losses recovered, 1,000 Rand, and we have to rectify our sales figure with that amount. The investment income comprised of the following. Dennis Limited paid 3,000 Rand in dividends and 7,000 Rand in interest. The remainder of the investment income was received from Suzy Pty Limited. Now, they don't ask us to do the note on investment income. If they did ask us to do the note, I had to distinguish between income received from listed investments, and then I have to distinguish between dividends received and interest received. Then I have to show them income from unlisted investments, and again I have to distinguish between dividends received and interest received. In this question they do not ask us the investment note, and they don't tell us that everything hasn't been recognized as yet, so that 14,000 Rand, the interest as well as the dividends received, that will be shown under investment income on the face of our income statement. So here, investment income, a total of 14,000 Rand. Salaries and wages. Now, salaries and wages is been shown here as a separate line item, 120,000. So clearly, it is not included in either of one of those three items. So we have to go and distribute that and park it in the correct place. Salaries and wages, and that's the 120,000 which appears on the trial balance, consists of managing director's salary 20,000, admin salaries 30,000, other non-executive directors for serving as directors 16,000, fees for Mr. Flint to take minutes at the board meeting, he's a non-staff member 3,000, and operating salaries 51,000, which gives us the total of 120,000. So you could have spread it immediately and allocated that to the correct place where it should belong. Or what I've done is I took the full 120,000 to operating expenses. And then I took out which doesn't belong there. It's my operating expenses. Here it is. I took the full 120,000 there. And then I went back to the question and I said, okay, what doesn't belong there? The managing director's salary of 20,000, is that the other operating cost? Yes, it is. But it's also a separately disclosable cost under my note. Admin salaries of 30,000, well, that's clearly not an operating cost, so in my calculation, I have to take the 30,000 Rand out, and I have to transfer that to my admin expenses, 30,000 Rand admin expense salaries. Then my fees for Mr. Flint, now he's taking minutes. Now, minutes is an administrative task. So that 3,000 Rand should also be transferred to our admin costs. So I took out the 3,000 out of my operating expenses and I included in my admin expenses. So I added it my admin expenses and I subtracted it from my operating expenses. Operating salaries. Well, now clearly operating salaries is part of operating costs, so that is going to be shown in that item as is. Now let's see what is separately disclosable items here. You know that we have to show directors' remuneration. When we show directors' remuneration, we have to distinguish between executive directors and non-executive directors. Under each one of them, we have to disclose whether it was for services rendered as directors, for managerial services rendered, or for costs that they have recovered from the entity. So clearly the managing director, he's the executive director, and the salary that he will receive will be in his capacity as the main man and the main chappie in the entity. So he's performing a day-to-day task, and for that he's getting a salary. So that 20,000 in our note under expenses, yes. Directors' emoluments, executive directors for managerial services, and there is the 20,000 Rand that he has received. Now, there's no other payments made to executive directors. For non-executive directors, the payment was made for serving as a director. So as directors, 16,000 Rand. So non-executive directors for services as directors, 16,000 Rand. Fees for Mr. Flint. He is not a staff member, so therefore it's a professional fee that I've paid, and it is of an administrative nature. But in my note, I have to disclose professional fees. So under expenses, professional fees for services, secretarial, taking notes is a secretarial type of activity, and that is a 3,000 Rand that we are going to disclose here. Remember, our profit before tax note doesn't add up to anything, guys. It is certain selective items that we just have to disclose because IS1 is requiring us to disclose those items in the note. So it doesn't add up to anything. It doesn't balance back to any figure in my income statement. It's just a random number or lot of information that I have to disclose according to IS1. If you're going to disclose the wrong stuff in this note, I'm going to subtract marks from you and you're going to be severely penalized. So make sure that you're only going to disclose the items which you are supposed to disclose according to IAS1. Go and have a look at your statements, your illustrative set of financial statements. Great, then we've done that. Number 8, included in other admin expenses is R2,500 for settlement discounts granted. Goodness gracious. So we are going to take that out of our admin expenses, and where should it go to? If we grant a settlement discount, we have to reduce our sales figure with that. So under our calculations, here, admin costs, we're going to take out the R2,500, and then against sales, we're going to subtract that R2,500. Other operating costs includes an audit fee for the year of R14,000. Oops, I've missed something. R800 was paid for subsistence and traveling of auditors, which is included in admin expenses. Now, when an auditor performs an audit, so a real audit in the true sense of the word, it is classified as an administrative kind of activity. So the audit fee and all the expenses associated with that audit will be shown as an admin expense. Where the auditors are going to perform a consultative type of service to the entity, I'm going to classify that separately, and I will have to have a look at the nature of the service that they provided, and then decide where I'm going to park that expense. Regardless, we have to show in our profit before tax note or our profit out of operations note audit fees, and under that note we have to distinguish between services rendered as auditors, which is the 14,000, other services rendered, which is not here, there is no other services rendered, and then for costs, and the cost is here, that is R800. So the R800 is already in admin expenses, which is right, so we're not going to fiddle around with that one. Other operating costs include an audit fee of 14,000. So we're going to transfer that cost out of other operating costs. There it is, minus 14,000. And we're going to include it into admin expenses. Audit fees, 14,000 Rand. Normal income tax should be calculated at 28%. The wear and tear allowance amounts to 20,400. Guys, don't worry about this. We're going to do this when we're going to do companies. I'm just going to show you that there's a little tax calc involved. It looks like that. It starts with my profit before tax once you've completed your income statement. And then you're going to certain income items like dividends received is not subject to tax, so we're going to take it out. He's not accepting your depreciation calculation, so you're going to add back your total depreciation, and you're going to claim from him what he calls wear and tear allowance. That is his words for depreciation. He doesn't call it depreciation, he calls it wear and tear. So you're going to subtract the 20,400, and then you're going to get something that we call taxable income, and based on taxable income, you're going to provide 28%. And to get your tax charge for the year of 61,257. And that's your tax charge for the year in your income statement, 61,257. Now at this stage, probably I would only have told you that the income tax charge for the year equals 28% of profit before tax. Then you would have worked out profit before tax, took 28% of that figure, and that would have been your tax expense for the year. So don't worry too much about that one at this point of time. Great, let's return to our trial balance and let's complete our income statement. Sales. Now sales, we can complete our sales figure, which we call revenue now. It will be the 720,000 which they gave us. Oops, this is a funny. Less 1,000 Rand credit losses, which was included in that, less 3,000 sales returns, less the settlement discount, and that gives us a final figure of 713,500. Cost of sales. Cost of sales is now again, like we've always calculated that, opening inventory, which was 19,000, plus purchases. There was purchases 285,000, less the discount of 1,200, plus freight on purchases of 3,500. less closing inventory of 16,000. Opening inventory plus purchases plus freight. There was freight on purchases as well. Somewhere, don't forget about that. Freight on purchases of 3,500 plus minus the 1,200 the discount received minus the closing inventory, and that will give us then total cost of sales of 290,300. Gross profit then, the difference between the two, 423,200. Other operating income. Now, if we go back to our income statement, our trial balance, you will see that we have rent of 14,400. Now, that is the other operating income figure, and that is also a figure that we have to disclose in our profit before tax note. So, under income, rent income 14,400, other operating income will be 14,400 plus our profit or gain on the sale disposal of the asset of 5,125 plus the credit losses recovered of 1,000 rand, and that will give us total operating income here of 2525. Distribution costs. Now that was coming back. Advertising costs, 10,000 rand, clearly a selling and distribution cost. Freight on sales, 12,000 rand, clearly a selling and distribution cost. So we have to add that, and then other distribution cost was 16,000. So that was the sum total of all our distribution costs, which is 38,000. Admin expenses, well, here we have a long calculation, and once we've done this whole calculation, it gives us a total of 84,800. So total admin expenses, 84,800. Other operating expenses, we've done this long calculation here, that will give us a total of 108,875. And that will then give us then operating income 212,050. We're going to add investment income, we've spoken about that. We're going to subtract finance costs, we've spoken about that. We're going to get profit before tax, and then tax, we've spoken about that, and then profit for the period, which incidentally there, I only see that now, 217,250 must be minus 61,257, 155. 993, 155, 993. Great, let's just have a look at our profit before tax note. Do we have everything now? We have the rent income, we have the profit, we have the credit losses, expenses. Audit remuneration, here's our audit fees, 14,000, the cost of 800 rand. Remember that was in this, there was the 800 rand, there was the 14,000 rand, so we have to disclose that in the note as well. Depreciation. Now here we have per class of asset, we have to disclose our depreciation, and that was the 14,000 plus the 1,125, which was on the vehicle that we've sold, plus the 9,800. There was the 1,125, that was the depreciation on the assets sold, plus the 14,000 that they gave us, which will give us the machinery and equipment a total of 15,125 and the vehicles of 9,800. Professional fees, that was the salary of Mr. Flint of 3,000 rand that we have to disclose separately. Employee costs, we have to show employee costs as well. So employee costs in this case will only be salaries paid to our employees, and that would have been the 30,000 paid at admin salaries and the 51,000 operating salaries, which in total gives us then total employee cost of 81,000. We have spoken about the director's emoluments. We've spoken about the credit losses. Then in our trial balance, there is, here it is, loss to factory due to wind damage, 5,000 rand. Now that is also a separately disclosable item. Anything that happens to your non-current assets basically needs to be disclosed. So that loss due to windstorm damage, 5,000 rand, that needs to be shown as well. Please go through this question again. Make sure that you can do that. Make sure you know which items you must disclose and which items is not a disclosable item. Make sure that you can answer a question like this, and make sure that you go through your set of illustrative financial statements where you're going to study all the items that need to be disclosed in this note. You just have to know that. There's nothing to understand, you just have to know that.